Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Gold surged up to $840 yesterday, although it is now back to about $830. The US dollar is getting beaten up in foreign exchange markets. The reason? The international credit crunch is biting with a vengeance. Today we look at another marker for risk, oil prices. We also review yesterday's rate hike in Australia, and we'll review what the other media are reporting. But first, we'll take a look at the latest unemployment figures. Even though the official reports out today say that the unemployment rate is 3.6%, that is the seasonally adjusted number. The actual number of unemployed people is 75,500, and out of a workforce of 2.2 million, that makes the real unemployment rate 3.4%. And 3.4% is the lowest we have seen in modern times, certainly in the last 20 or so years. The participation rate, however, has slipped just below 68%, which may indicate that we are topping out in labour force participation. We expect it will rise 1% or so in the fourth quarter, a usual seasonal rise. Another indicator that may suggest we are very close to full employment is the number of part-timers who are now seeking more hours. That benchmark fell below 80,000, and it always seems difficult for it to remain below that level. Today's overall labour force survey results show that this market is very tight, and until immigration to Australia slows or net migration rises, it looks very like we'll remain that way for some time. As expected, the Australian Central Bank has hiked their cash rate target another 25 basis points in an early effort to stem the inflationary effects of their booming economy. What is somewhat unusual about this increase is that it has come right in the middle of their election campaign and is expected to seriously hurt the ruling party. But the RBA does not feel it can wait. Inflation is currently at the top of their target range and is threatening to push higher. Their higher exchange rate is restraining price rises, but not enough to counteract the high levels of domestic demand. And that election has introduced new huge tax cuts and extra spending, promises made by both political parties. It is all expected to push inflation much higher. The first effect will be on mortgage rates. Most Australian mortgages are on floating rates, and with this latest increase they will now be paying well over 8.5%. Official rate changes in Australia flow through to bite consumers much more quickly there than they do here. Yesterday we looked at the gold price as a marker for international uncertainty. Today we look at the oil price, another marker for uncertainty. According to the latest monitoring of the crude oil price by the Ministry of Economic Development, the Dubai benchmark crude price for 1 month forward contracts, the key price that drives our local petrol and diesel prices, well, that price has now risen to $84 a barrel, or almost 110 New Zealand dollars. Our rising exchange rate is keeping a lid on international price rises, helping to restrain them. There are 159 litres in a barrel of oil, so the crude oil component of petrol when you fill up at the pump is 69 cents. The rest is what the oil company makes to refine and deliver it, about 29 cents, and the balance is tax, about 70 cents. The last time we looked at this, we warned about pump prices touching $1.70 per litre. Well, they're there now, and probably they're going up from here. But one thing is certain, a $90 crude price will encourage a huge increase in more exploration and equally in energy efficiency. We're not about to run out anytime soon. We'll just need to pay a bit more. Surprising many, the OECD has shown recently that energy efficiency improvements out of Europe have been modest, while energy efficiency improvements out of North America and China have been dramatic. And they will no doubt continue, with the benefits of their improved technology flowing to us all. Reserve Bank Governor Alan Bollard is confident about the state of New Zealand's financial system during a time of turmoil on world markets and after the failure of several finance companies. Releasing the Reserve Bank's twice-yearly financial stability report, Dr. Bollard said the country's financial system was sound and had been reasonably resilient against the backdrop of worldwide market volatility. That volatility, however, has gotten much worse since he wrote that report, and tomorrow we'll bring you up to date with those developing risks with a detailed review by Dr. Neville Bennett. Receivers have announced some updates. Investors in 5 Star seem unlikely to get back more than a quarter of their investment, apparently because lending that company did was outside normal commercial lending practices. Western Bay's finance depositors will get back about 82% of their investment, more than the receivers first estimated. You can get more news and stay up with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.